The Basel Accords. A comprehensive overview for banking professionals. Understanding the intricacies of financial regulation is essential for banking professionals. Among the multitude of frameworks that shape the landscape of global banking, the Basel Accords stand as an indispensable guideline. Historical background. The genesis of Basel Accords. The Basel Accords originated from the Basel Committee on Banking Supervision, BCBS, established in 1974. Following the collapse of Bankhaus Herstatt in West Germany, the committee was formed to address the repercussions on the international financial system. Originally composed of G10 countries, the committee has since expanded its network to include 45 institutions across 28 jurisdictions. With regular meetings throughout the year, the committee continually evolves and strengthens the regulatory environment for international banking. Basel I, the onset of risk-based capital requirements. Introduced in 1988, Basel I, officially known as the Basel Capital Accord, aimed to standardize capital adequacy requirements. It mandated banks to hold a minimum of 8% in risk-weighted assets, addressing concerns about capital ratios in the global banking system. Over time, amendments were made to Basel I to include provisions for loan losses and encompass not only credit risks, but also monetary risks. Basel II, an enhanced framework. Basel II, implemented in 2004, succeeded the 1988 Accord. Building upon its predecessor, Basel II introduced new dimensions, such as an internal assessment process and increased cooperation between home and host supervisors. These enhancements aim to bolster market discipline and enhance banking practices. Basel II expanded the scope of capital requirements, allowing for more granular risk management strategies. Basel III, addressing systemic inefficiencies. Basel III, introduced in response to the 2008 financial crisis, addressed not only the crisis, but also underlying systemic inefficiencies and governance failures. Revisions made in November and December of 2010 focused on the quality and quantity of common equity. The minimum requirements for common equity were raised from 2% to 4.5% of risk-weighted assets, accompanied by a capital conservation buffer of 2.5%. Additionally, Basel III introduced a leverage ratio to enhance the overall resilience of the banking system. Supplemental features and continuing evolution. Basel III brought liquidity risks to the forefront of regulatory concerns with its framework for monitoring liquidity. The Basel Committee has continually updated its principles, with the most recent update outlining 29 principles in September 2012. For banking professionals, understanding the Basel Accords is crucial for navigating the regulatory landscape. Stay informed and up to date on these guidelines to ensure compliance and proactive risk management. Want to learn more? Claire Trithel on LinkedIn.